The very first thing would be, let's get at least 3 months expenses on your personal side set aside in a savings account, just with that extra money that comes in per month. So set up a money market or a checking or savings account separate than your personal account. We call that a wealth capture account. Start automatically putting that extra cash after you refinance into that account. So you've got some safety measures and some contingency planning so that you don't have to go just rack those credit cards back up again.
Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions.
Welcome, Ryan O'Shea. It's good to have you here. I don't know if you consider being called a money nerd like a compliment. I remember Michael Hodge on the team was like, no, we should call them money studs. I'm like, that's just nerdy to try to call yourself a stud. But he's older than us, so maybe that's what it's about.
I'm okay with being a nerd. It's all right.
Yeah, it's kind of like the new cool, right? Like, well, great, man. I know you deeply research. You like to, you have this whole science background and botany and everything, and then you take that and apply some of those methodologies and thinking processes to money. So we've got quite a few questions here. I'm excited to dive in. And for those of you watching, you go to askthemoneynerds.com to ask your question. These are actually questions that came in. And part of the reason we do this is great for us to know what's going on out there in the marketplace as we're writing books, as we're creating content, as we connect with people. And my objective is to help 1 million people achieve economic independence. And so we've created multiple platforms to do that. And as we have this podcast, once a week, we answer these questions. So today I've got Ryan O'Shea, someone I've known from, really, I think I was probably in high school when I met you officially, or really remember. We played basketball together. He was older than me and better than me, but that's okay. I'm not bitter about it at all. And then he ended up working at Fidelity, and I said, well, you should come check out what we're doing. Then he created his own registered investment advisory, and then now he's associated with one so that he can focus on work with clients versus navigating all the workings of that business. So glad to have you here today, Ryan.
Yeah, thanks, Garrett. All
right, we've got a question from Timothy. He's a 53-year-old employee with $100 left over each week. So if he's lucky, he says, and $49,000 in an IRA, he can't touch without getting hit for 30%. He's wondering what he can do to turn the crappy life around. I'll give him some advice maybe on production, if you can give him advice on the investing side. He's looking to turn his 15-year mortgage into 30-year so that he can get about $11,000 out to pay off 3 credit cards, which I think that could be a great idea because credit card interest is going to be a lot higher than mortgage interest. You just got to be a little bit careful not to go spend that extra cash flow, right? You got to make sure to save that, and that's going to boost that $100 that's left over. He's hoping out about $200 per week doing just that, which is awesome, right? And he's watched a lot of our videos, read a lot of articles. So what options does he have, Ryan, with his IRA? There's a 401k transferred over from a brokerage account from a past job, and he really can't touch it without penalty for 7 years. So you're the expert on this for sure. I'm glad we got you to answer this question.
Yeah. So what you should be doing with your IRA kind of depends on what you've got going on elsewhere. So it sounds like he may not have a ton of kind of the basic savings, just cash reserves, things that way, which tells me that money should probably be invested pretty conservatively, because in an emergency, you might access it despite the penalty and the tax consequences, especially if you don't have a cushion built up and just haven't taken care of the basics, kind of, built the foundation for your finances first. A lot of people get trapped into the 401k first model, where it's like, really protect yourself first, then you go invest there. The way I describe it is you earn the right to invest by building your base.
So what do you think about a self-directed IRA? What do you think about a Roth IRA conversion? And does he have any options? Because he's got this, this big tax bill that would come with it and a penalty. What options does he have in those arenas? And what's your opinion?
Well, so the self-directed is used in kind of two different ways when you describe an IRA. So it sounds like you may already have a self-directed IRA, which means you choose how you invest the money. And you could do that at any one of numerous brokerage houses, where you choose whether you're going to buy certain stocks or certain bonds or funds or things that way. That's self-directed. Well, the other self-directed that people talk about is, well, what about alternative assets? And how can I own those? And that's something you can do. But there's particular companies that are not your typical brokerage houses that do that type of thing. The trap I see people fall into there is they get to the point, and it sounds like Timothy is at this point a little bit, where it's like, hey, I'm getting close to retirement. I feel like I'm behind. How do I make more money? Well, then they end up chasing a rate of return, getting into private investments that promise great rates of return. And then the next recession happens and your money went to zero.
A lot of the private investments don't have the type of market to liquidate that other traditional investments might have. So they might be tied up for a long period of time. You might be dealing with more amateur level investors with some private investments. It might be a new venture for them, and a lot of the startups don't work. So something to definitely be cautious of. With the $11,000 on credit cards, is there really any way that he could access the IRA to pay off those credit cards, or would he just be simply facing a penalty and paying the tax?
I mean, there are certain ways to access a portion of that, but unless it's a really large amount of money in an IRA, it's not worth the administrative headache.
Right, because what's that one provision that's mainly used in divorce that lets people avoid the penalty, but it would cost half of what he's paying off in his credit cards to even consider, right?
Yeah, exactly. Yeah, so there's a couple loopholes there. One's in divorce. There's a 72T, which is basically an early retirement election. There's some things that way, but it's not like these are
not worth it.
Not typically worth it, and administratively heavy. So it's like, yeah, you can do these things, but plan on getting a letter from the IRS in 3 years, and plan on having your CPA need to respond to that, even if it's legitimate. And it's like, well, now you just cost yourself $800 in fees to your CPA. Did you at least save that?
Right.
On the other side.
And on the Roth conversion, advantages, disadvantages. What's your opinion about that?
So the Roth conversion, basically, you're going to pay tax, but if you access the money before 5 years or 59 and a half, whichever is greater, the whole 10% penalty is going to come back on the whole amount. Whereas in a normal Roth, the penalty is just on your gains. Well, if it's a Roth conversion and then you access it, they're going to treat it like it was the traditional IRA.
And if you pay taxes from inside of the IRA, is that penalized on the conversion?
Correct, because you're going to have to take a withdrawal out of a traditional IRA to pay the taxes, and then that's penalized in tax.
So he couldn't really move to a Roth and pay off the credit card, because if he moved to a Roth, he'd probably have to use the money off the refinance to pay for it. So that's not necessarily a good option. I mean, I like that he's considering refinancing. And I think a lot of people, Ryan, are probably scared about going from a 15-year to a 30-year because they go, well, now you're going to pay so much more interest. But we always have an interest cost, whether we pay cash and forfeit the right to earn interest or whether we pay the bank interest. Most people only think about what they're paying the bank. And so, yes, there's a risk by lengthening that loan because, basically if Timothy were to go out there and spend the money, then that is all for nothing. And he's got this longer period that he's paying those credit cards, even though at a lower interest rate. So, this will get him ahead of $100 each week. It'll add another $200 per week. And Timothy, for you, maybe even consider, is there a side hustle? Is there so many people right now have 1099 income because they offer things or do things. The simplest of those being Turo, where they rent out their car, or Airbnb, where they rent out a room in their house, to driving for Uber or Lyft, but then there's tons of, companies out there for people that are graphic artists, or, there's a number of those things. So if you could find a way to increase your income because there's more coming in, if you can invest that back in yourself and in your skill set, maybe there's a way to grow that spread further where there's more coming in. And then obviously you can look at cash flow banking. Ryan could speak to that. That might be a place to store some of this cash so that you are building up that cash so you're not stuck in the mortgage for 30 years. You have liquidity and access to money in case there's opportunities that come your way. And you've also just built up a bit of a peace of mind fund that isn't predicated upon what the stock market does. So the first thing I heard you say, Ryan, is you should be pretty conservative with the money inside of the IRA, considering the amount that we're talking about and everything else that's out there. A Roth conversion doesn't make a lot of sense. A 72T that lets you get the money out without penalty doesn't make a whole lot of sense. But building up savings and safety makes some sense. Finding a way to take this extra income and capture it somewhere like cash flow banking could make some sense. And then I'm saying, yeah, invest back into yourself. I mean, I feel like Timothy's on a pretty good track with some of these thoughts he has here.
Yeah, I agree. And yeah, the reason I talked about being conservative with his investments is it sounds like there's not a lot of liquid savings not in retirement accounts.
Right.
So So that makes your retirement account your backup plan.
Yeah, so the very first thing would be, let's get at least 3 months expenses on your personal side set aside in a savings account, just with that extra money that comes in per month. So set up a money market or a checking or savings account separate than your personal account. We call that a wealth capture account. Start automatically putting that extra cash after you refinance into that account. So you've got some safety measures and some contingency planning so that you don't have to go just rack those credit cards back up again.
Yeah. And I like to see that wealth account 1 degree separated from your day-to-day banking. So instead of like an emergency savings, which is a separate thing, being maybe a savings account at your bank where you already have your checking account, I like to see your wealth account somewhere else.
Yeah.
Whether that's an online bank, or I use a brokerage account for mine actually, but so it takes a deliberate decision to transfer the money and might take a couple days to access. So you don't make a rash decision and just drive a nicer car without thinking about it,
All right. Well, Sandra has a question, and she says she actually has 2 questions. One, what are the best financial advisors recommending clients invest in when interest rates drop? And so did the Dow Jones. And then more importantly, number 2, if a corporation owes a gigantic sum of money to a person and will be paying in securities, how does the drop by the Dow Jones affect the person the corporation owes? Is the money that the owed person will receive of less value than before the Dow Jones drop?
So the second part, I definitely want you to read to me again, because that's kind of complex.
Yeah.
But as far as interest rates dropping along with stocks dropping at the same time, what a lot of people will do is a flight to safety. Unfortunately, probably at the wrong time most of the time, because by the time people know to react, the bad stuff's already happened. Which it's why typically with my clients I'm a defense first, offense second person when it comes to investing. So then you're the person who does have liquidity when things are dropping, so that you can actually go make purchases. Ironically, if you own bonds ahead of an interest rate drop, though, you're in good shape.
Right.
Your prices are
going
going
for more if you want, and you have a better interest rate than those that are buying afterwards.
Yeah. Post 2008, post kind of last economic crisis, we actually sold some of our clients' bonds because they had popped so high. And
that's an inverse relationship. When interest rates go down and new people are buying, right, they're getting a lower interest rate. So if they could buy an old bond with a higher interest rate, they got to pay a premium. And so, for those that aren't familiar with that, thanks to my college education, I actually learned that through college. But then also, I at one time passed my Series 6, 63, and 65. So I can remember a couple of these things, Ryan.
Yeah, totally. But yeah, it ends up kind of with an inverse relationship. You can choose to sell your bonds at a gain, or you may just hold on to them because you've got a better interest rate going than the marketplace out there.
So the second thing I think depends, but she's saying, hey, what if a corporation owes some sum of money and pays in securities, but then the market drops, right? How does that affect the person the corporation owes, right? So is the money that's owed the person of less value, than before it drops? So I guess it would depend on the agreement, but I'll let you answer that.
Yeah, well, it depends on the agreement. And also, if you're saying whether the money's worth less or worth more, if it's measured in dollars, then we're talking about inflation.
Right.
And it's like, well, is it worth less or worth more based on inflation? But them paying you in securities in lieu of debt, there has to be an agreement there.
Yeah, so either that was paid in securities and it's over, or it's paid in securities with strings attached, right? And it depends on what those strings and contract agreements are.
With contingencies and things that way. I've also seen them paid in preferred shares that have an interest rate attached to it. So it's an equity, but with a favorable interest rate.
Right. Is that securities exchange paid in full, or is it simply a collateral piece, or that they're now getting payments on? So it all is going to be spelled out in the contract, essentially.
It is, or in a bankruptcy court potentially.
Yeah.
So
I want to thank Timothy and Sandra for our questions today. If you have questions, you can go to askthemoneynerds.com. I'll be bringing Ryan back and asking him even more questions, because we have quite a few on the investment side, and it requires his expertise and a registered investment advisor, of which I am not. I'm an author and I'm a curator that finds great relationships that can create the nuts and bolts, and I kind of bring the high level picture. So Ryan, I appreciate your time today, and Timothy and Sandra, I really appreciate your questions.